Live stream for Constant Investor this week. I'm Alan Kohler, and great to see you. Thanks for joining me. Now, as always, this live stream today is general advice only, and may not be appropriate for you. Today's my birthday. I was born on 26th of April 1952 at the Oakley Hospital, and I was taken back by my parents to live in a garage which my father had built, and we lived in there until he built the house, making the bricks himself. But that's perhaps a story for my memoir, which I won't bore you with today. But anyway, that was 66 years ago, and here I am turning 66 today, and I've told the kids that what's happening to me is that I'm getting younger each year instead of older, which is amazing, really. It's a sort of biological phenomenon. I certainly feel younger every year. That's the case. And I asked the guys. I went to get a coffee this morning and asked the guys at the coffee shop how old do they. I told them it was my birthday, and I said, "How old do you think I am?" And they said, 57. So there you go. Apparently I look 57. That's a beautiful thing. I certainly feel that. Anyway, and the other thing that's occurred, which is also making me feel younger, is since we last spoke last Thursday, is our first grandchild has been born on last Friday morning. So is now getting up for a week old. And his name is Alfie, which happens to be my family nickname. So he's kind of named after me, and that's a great honour as well. So, but his actually name is Alfred Freeman Mills Manning, because the surname is Manning because it's my daughter Alice who's the mum. And so anyway, that's terribly exciting, and it's been certainly the biggest event in our family for quite a while. He's apparently coming over to our place tonight for dinner, for the birthday dinner, which will be his first excursion away from Alice and Henry's house. So that'll be exciting as well. So that's just bringing you up to date on all the family news. The other thing to tell you about, to just remind you about, is our Sydney event, which is on Tuesday in the evening, starting at 7 o'clock, so get there at 6:30 to 6:45 if you'd like to come. I think it'll be terrific, and I've just had a discussion this morning with my fellow panellists, Alex Pollock, the founder and CEO of Loftus Peak, the disruption investors, and also Joanne Masters, who's the senior economist at ANZ, and she's also done a lot on disruption as well as keeping on top of the economy. So, you know, we'll be able to answer any questions you've got about the Royal Commission, about retail disruption, about whatever's going on in the world. I think should be a terrific event. Places are filling rapidly, so jump in and get a ticket, $25 to cover costs, $50 for non-members. And, you know, if you've got someone you want to bring at the same cost as a member, we'd obviously be happy to treat any of your friends or family members as members, and also charge $25. So please take advantage of that, and I'd love to see you on Tuesday evening. So let's get stuck into the questions. Now, Dan says, last week you mentioned Spark. SPK is the code, as an unfranked dividend stock. It's a New Zealand company listed on the ASX. Indeed it is. But does New Zealand have a franking system of their own? Does that affect the dividend paid to Australians from companies like Spark? The answer is yes. New Zealand does have a dividend imputation system, and the tax office also, the Australian tax office also has a special system to deal with New Zealand companies, which is that they get to join the Australian dividend imputation system as long as they've got Australian revenue. So if a New Zealand company has Australian revenue, it can frank its dividends to that extent. Spark, SPK, is entirely unfranked, that is to say 0% franked, because I presume, and I haven't looked into this in detail, but I guess it's because they have no Australian revenue. They're entirely a New Zealand company. So for Australian investors, their dividends are unfranked, 100% unfranked, whereas obviously for New Zealand investors, I would say they're 100% franked. But you've got to be a New Zealand investor to get the benefit of Spark's franking. But as I say, there are some New Zealand companies, and I couldn't list them for you, but there are some New Zealand companies that have Australian revenue, and for them, their dividends are franked to that extent, whatever that percentage is of their Australian revenue that's paying Australian profits. John says, I want to make an investment in commercial property, either listed or unlisted. This would be for my super fund, primarily for income. Quite a good idea, John. I'm with you there. Are there funds you might consider? General advice only, of course. Of course. Well, there are 43 listed real estate investment trusts on the ASX, and you can find them by going, if you just Google ASX product list, you'll find a web page that has a number of tabs across the top, and one of those tabs says A-REITs, which stands for Australian Real Estate Investment Trusts. Click on that, you'll see the list. There are, as I say, there's 43 of them, a wide range of probably of quality, but certainly a wide range of things that they invest in. I've done a few interviews with them. I've interviewed Cromwell, which is a South African one, also Centuria recently in the last few weeks. I've interviewed Stockland, Mirvac, who else? A few of them. So you'll find a few of them on the Constant Investor website, having been interviewed by me. I quite like the sound of Centuria. I thought that was pretty good. Cromwell's, as I say, they've been around a while. They're South African. Anyway, look, the best thing to do is go through the list and see which ones appeal to you. As for unlisted ones, well, I can't find a list of them somewhere where I can, here they all are. I think there's thousands of them, to be honest. They tend to be syndicates of investing, investment trusts to invest in an individual property, whether it's a shopping centre or an office building or something. So you can really just sort of Google them, I think. There's one I know, one group I know called Sentinel Property Group, which is run by a bloke called Warren Ebert. Now, I just happen to know him. They do pay very good income. And I think their returns are in the order of 10% plus, up to 15% in some of them. So Warren's what Warren is, he's a pretty good identifier of properties. He scours Australia all the time for undervalued, in particular shopping centres, but also office buildings that need renovation. So what he does is he identifies these shopping centres that have to be renovated. He buys them in a fund, puts out the syndicate to investors to invest in, that generally fill up pretty quickly. They buy the property and then they renovate it and they get the rent up. And so his returns are pretty good, and I think he's quite skilled at identifying and finding these undervalued properties. So I haven't interviewed Warren for 12 months. You'll find him on the website if you search Sentinel on the Constant Investor, or Warren Ebert, E-B-E-R-T. So I interviewed him about a year ago, in which he described what they do and how it all works. So that's still valid, I think. I haven't spoken to him for a while, and I don't think he's changed his model. And you can look on their website. So that just happens to be one I know, but there are plenty more unlisted real estate investment opportunities around. It's just a matter of hunting them out, I guess, through Dr. Google. Marty says, I've just looked at what XT means on share sell buys. It seems almost all the managed funds I am in are traded XT. I gather this means there's a relationship between the fund manager and the broker whereby they pay nothing for the trade, but I do. Can anyone let me know if I'm on the right track here? So that was a general message on Facebook by Marty. So I haven't looked at whether anyone's answered that, but XT, Marty, XT means special crossing, and basically it just means that a broker has traded shares between two clients, and so that hasn't gone onto the market as a trade. It's basically been done in-house. They happen to have a client who wants to sell a particular parcel of a particular stock, and they've got a buyer of the same parcel, and they do what's called a special crossing in-house. Now, how the thing works in terms of who's paying, well, of course there's brokerage, and it isn't really true where they pay nothing for the trade, but it is true, Marty, that clients always pay. Clients pay everything. You can't, all the brokerage, all the fees are ultimately paid by you. So there's nothing, the fund manager, when you buy a managed fund, you're ultimately paying the brokerage as well as the fees and the rent and you name it. I mean, there's nothing they kind of do themselves, that's for sure. So there's nothing particularly wrong with the special crossing. There is brokerage. It goes into the brokerage goes into the fees that you pay, and so therefore you do pay. But as I say, you pay everything because you always do. Peter says, after reading Percy Allen's book, I'm interested in investing in a market-neutral fund like Watermark to protect against downside movement in the stock market. I wonder if you could have a special program on these types of funds and what you thought about investing in this sort of fund. Yeah, well, I can certainly do some work on it for you and do some interviews. I did interview Justin Breitling of Watermark a while ago. I can't remember when it was. When was it? Look, you can find it. You'll find it on the website, like everything else. Just it's a pretty good search. We've got a pretty good search engine, to be honest. If you search Breitling or Watermark, that's Braitling. Justin is the manager of the Watermark fund, and he describes in that interview what's going on. Watermark. It's called a market neutral fund, and the way they achieve that is by having long short. So they balance all their long investments with shorts, so that if the market goes down, they don't lose, they win. So that and they manage, but they have managed to achieve a return that's greater than the ASX 200. If you go onto their website, onto the website showing the returns of the market neutral fund, you'll see that the return is quite good. I think it's, from memory, I think it's 13% per annum. So it's pretty good, and as you say, it does protect on the downside because they've got short positions in place that balance their long positions. I'm not, as to what will happen if they get totally tested, I'm not sure, but there they are. I'll suss out other market neutral funds for you. I may be able to find a few and do a special number on it. We'll try to do that, Peter. And of course, the other way to respond to Percy Allen's book is to keep watching his work in the market timing newsletter that comes out as a part of the Constant Investor on Sunday mornings. It's pretty regular. It's 7 a.m. Sunday mornings. Percy writes to you as a part of the Constant Investor, telling you what his signals are. And what he's doing with his work is keeping an eye on the charts, and his work pretty much identifies when there's likely to be a crash. I think he's got it down. So you can protect your downside by following Percy in the Constant Investor, as well as his book. But also market neutral funds are worth a look as well. So there you go. Robert says, I do recall that you are an avid follower of Warren Buffett. One of Warren's favourite books that he has read and recommends is Where Are the Customers' Yachts? Have you read this book, and do you think the title applies to what is being discovered about bankers and financial planners by the Royal Commission? The answer is I haven't read the book yet, but I know of it. It's by a bloke called Fred Schwed, which is a terrible name. Fred Schwed Jr., I think. It's S-H-W-E-D, Schwed. And it was written in 1940, and it was principally a result of the fact that Fred lost all his money in the 1929 crash, and wrote about the Wall Street. It's also got a subtitle, A Hard Look at Wall Street. You know, and I think it gets updated, and I think you can also get a free download of it if you Google that. I think you might find that you can download a PDF of the book now because it's so old. It's like 78 years old, and I think you might find that you'll be able to get it for nothing. But anyway, it doesn't cost much to buy it. So I reckon, you know, if Warren Buffett and Peter Lynch and a few of the other famous investors all like it, then it's probably worth a read, and I probably should read it too. And so I'm going to download it myself and have a look at it. Thank you very much for recommending that to me, Robert. I haven't got around to it yet, but it's going to be on my list now. Sounds fantastic. Roger says, why should shareholders take the pain for criminal behaviour by employees? Why aren't the criminals jailed, starting with the CEO, and their assets confiscated instead? Well, that's an interesting idea. You didn't say this exactly, Roger, but implied in your question is the notion that if CEOs and other executives and directors are convicted as criminals, then perhaps their salaries are the proceeds of crime and should be confiscated. I think that's a very interesting idea, and maybe that's true. So obviously criminals are jailed, I mean, but they have to be proven to be guilty, and we still have the idea in Australia that everyone's innocent until proven guilty, and you know, it's very hard to prove these things. There's also something in the law called the business judgment rule, which protects business people from criminal prosecution if they made what they thought was a good idea at the time, and they can demonstrate that they thought it was. So sometimes it's, I think, difficult to distinguish between something that, you know, somebody obvious, basically something between an honest mistake and a deliberately criminal act. But, you know, the stuff that's coming out in the Royal Commission indicates that there was nothing mistaken about it. It was deliberate lies, in which case, surely, we're talking about criminal offences. So I wouldn't be surprised if some people were convicted of criminal offences. And I think it is an issue, an interesting point you raise, Roger, about whether or not their salaries are the proceeds of crime and should therefore be confiscated and their houses confiscated. I think that's a very interesting idea. But of course the other process is the class action, and it sounds a bit like the lawyers, the class action lawyers, Slater and Gordon, Morris Blackburn, and there's a couple of others I think, are queuing up to do class actions against the victims of the Royal Commission, who were parading before them and confessing to all these misdeeds. I reckon that there's some open and shut class action cases there, and I think that the class action should be directed at the individuals, not at the companies, because that involves the shareholders simply suing themselves. And so another way of confiscating the CEOs and directors' assets is to launch a class action against them individually and get their assets that way. So I think there's going to be a lot of action on this front in the months and years ahead, and will deserve quite a lot of watching. So that's it. That's the last of the questions. It's been good talking to you. Today's content on The Constant Investor includes Money Cafe, as always, and also a reasonably interesting CEO, Bill Oliver of Tando Resources. Now, Tando is a Commodore Garden gold, silver, copper, lead, zinc explorer in the Pilbara that has bought a vanadium prospect in South Africa. Now, vanadium has suddenly got hot because, you know, as well as being an additive to steel, to strengthen steel, which it has been for quite a long time, and it's still in use for that and still getting quite a lot of demand as a steel additive, it's now suddenly being used in batteries. So it's part of the energy revolution now as well, and it's not for mobile phone batteries or car batteries, it's for big stationary flow batteries that sound like they compete or will compete with the zinc bromide batteries that are being produced by Redflow. And anyway, it's interesting. They've got a fair bit of vanadium over there. Tando's share price has doubled on the strength of the acquisition of this prospect in near Johannesburg, and you know it's probably worth a listen. So Bill Oliver of Tando Resources, and don't forget our Sydney event. Check it out on the website. Thanks for joining me, and I'm going to head off to the Saporito Cafe to talk to Jay Kirby. Thanks a lot. I'll see you next week.